hopefully you're going to hear some stuff here in the next few minutes. It's going to help you win with your money. Always our goal here. This is brought to you by 360 Capital Management right here out of Southern Pines. I'm your host, Dwight Mejan. Alongside me, Mitchell Kaiser, my son-in-law, and Sam Davis, our executive producer. It's an honor that you spend a part of your day with us. We don't take that lightly, and hopefully you're going to hear some stuff here in the next few minutes. It's going to help you win with your money. Always our goal here. We have 5 pillars of wealth here at 360 Capital Management. We look at this with each and every client. And these are the 5 pillars of building and maintaining wealth. First one is allocation and your investment plan. The second one is your income plan. The third one is your tax plan. The fourth one is your healthcare and long-term care plan. And the fifth one is your estate and legacy plan. So I ask you this question. For those of you who have advice, if you're not self-directing your own investments and you have an advisor, or if you're self-directing, does that person who advises you incorporate and look at that and have discussions when you meet around all 5 of those topics? They're all intertwined. While there's separate planning in each of those areas, we view those as one financial plan, and that's the area that we at 360 Capital Management, this is in our wheelhouse. This is what we specialize in with our clients. Mitchell, why don't you take our listeners through tax rates in the past and just tell people real quick on this. This is a slide that we cover at our live events. If you have not been to one of those live events, stay tuned, get to our website. We'll post dates when those are coming up in the future.
Yeah, so just real brief, if you go back to World War I, that was back in the 1920s, tax rates were as high as the mid-70s. World War II, they got even as high into the upper 90s. They did dip back down a little bit around the Revenue Act of 1964. There again in down to the Tax Reform Act of 1986, which I think they dropped as low as about 30%. All that to say that we are probably about one of the lowest times in history for our tax rates and the highest tax rates. I think it was back between 1960 and 1963. Who was the president during that time, Dwight?
That would be Kennedy.
So Kennedy, he during his reign and presidency, the tax rates were between 26 and 87%. So an example, if you guys are working and you're in some higher income earning years, let's just say you're at the 24% bracket. If you were living during his time back in 1960, your tax rate could have been between 56 and 69%. So again, transferable today of 24% would have been more like 56 to 69%. According to cbo.gov, there's an illustration we like to show people of what future tax rates could be if they did a 3 tax bracket tier, the lowest being 25%, the middle bracket being 63%, and the top bracket being 88%. Again, that 88% is probably the higher income earners that are, well over $350,000, $400,000. That sounds outrageous, but again, back to the 1960 to 1963 era, tax rates were as high as 87. So you don't have to go back that far for taxes to be that high. So again, I'm going to go back to Dwight's point of what the importance is of having a tax plan. Because if you don't plan for taxes and you're planning to live in your retirement years between 10 and 20%, well, let me just throw the what if out there. What if taxes jump back to 30, 40, 50%? That's going to probably take your lifestyle and decrease the amount of income that you're planning to take by about half. So just some pretty serious things to think about with not that far back with tax rates to what could be in the future.
Yeah, there's a lot of unknowns, but I think everybody agrees, especially when we ask this at our live events and we get to see a show of hands. Most people believe tax rates are going up, and we're of that belief here as well. So developing a tax plan within your portfolio, very, very important, folks, because if you're in a bracket today, or let's just say you're one that gets caught up in a double digit and a significantly change of a higher double digit tax structure than you're in right now, you're going to have some regrets of saying, boy, I wish I would have known this. Well, if you're a listener of this show, you can't blame your hosts on that, because we talk about this a lot on this show. So make sure, folks, looking forward, and you're here, we're at the end of the year, this might be the perfect time to do some conversions this year for some folks. I had somebody come in this office last week that is going to be doing $110,000 conversion from an IRA account to a Roth account. Okay, we don't have time to get into the differences here between conversions, contributions, but they can move that money. There's no limit to how much they can move. But we ran a tax map for this client. Okay, it was actually a listener of the show. We ran a tax map, showed them what they were looking at, and forecasted under current tax rates. If they don't do that, what's going to happen based on presumed growth with this portfolio? It's been making about 7.7%. We forwarded that out a few years to when they're going to have to take money out. And if tax rates don't change, it's going to jump them from the current 12% to 24%, 12% more. If tax rates stay fairly stable, they're going to avoid that. We won't go into that more, but have that plan. Taxes, folks, are going up. I'm going to tell you, we did get news. Some of you probably followed the news in recent week or so that standard deduction is increasing. So if you're married, filing joint, that's going to $29,200 in 2024. If you're a single filer, it's going up to $14,600. So for a married filing joint, nice increase there. That is the good thing, I guess. One good thing we could say about inflation this year is it's raising the standard deduction, a lot of things. But I realize a lot of times it gets taken back, like your Medicare premium. You get adjustment in Social Security, but they take it back with the Part B cost. But there's a little relief there on the standard deduction side. So those of you in the land of fixed income, as you like to say, a little relief there for next tax year. So the brackets, we cover those in our event. The big thing I want people to understand about brackets, okay, the bracket that you fall in. Your effective marginal rate is the bracket that the last dollar that you took from your portfolio or from income, it's the percentage that last dollar was taxed at. That's your effective marginal rate. It's an important number to know, or percentage to know, and we make sure everybody who wants to know that number that comes in to get a tax map, we explain that to people. And we would show you, if you were a client with our firm, we would show you how your investment portfolio and your tax map would work together. I had a client meeting this morning, and I worked with a client on forward projections for 2023. This client is not going to have any surprises on their tax return. The year before they came to us, they had a huge surprise on their tax return, about a $50,000 tax bill they did not expect through some things that happened within a sale of something they made. They knew there were taxes owed. They didn't know it was to the degree that they were going to owe it. And had they had the information that we went over, these were his exact words. This isn't trying to make this about us. If I would have met you before we had done this, we would have done that differently. That whole transaction and how we took money out of the portfolio, we would have done it differently. Folks, most of people, your financial advisor and your CPA, they probably don't even know each other. And if they do, they probably don't talk to each other about your portfolio. That is one of the things that we at 360 Capital Management do, is we look at how the portfolio impacts your taxation. All right. That's all I'm going to say about that.
I'll just add to that, though, really quick, Dwight, because a lot of times we'll have people come in that don't know anything about IRMA, their IRMA tax, and how that has to deal with Medicare. In a 5-second definition, your IRMA tax is your income 2 years later that is going to affect your Medicare premium. And I'll just tell the story of my grandparents who are in their 80s. Decided that they wanted to simplify their life a little bit. So they unloaded a couple rental properties that they had. 2 years later, they noticed that their income shot through the roof. The IRMA tax counted that towards their earned income, and their Medicare Part B premium quadrupled. So what they were paying in Medicare now multiplied by 3. Therefore, what that all means is that their Social Security check went down. So if you guys are unaware of that, or how to unload properties, or how to make conversions and things like that, thinking that it doesn't matter or that you're going to do it all on your own, it really does matter. And I like the illustration that Dwight used, that people think of them as silos: a healthcare silo, insurance silo, a tax silo, and a financial silo, when ultimately you want them to be all working together for you, because they all do intertwine in one way or another.
But this is a big surprise. I see light bulbs going on in people's heads when I show them this at our live events, because most people don't understand the relationship between capital gains and ordinary income. I don't have time to dissect this at the time I'd like to, but here's what I would tell you folks. Capital gains are created through ordinary income. And I'll give you an example. Let's just say you don't even sell a second home that you have. Capital gains can come through regular brokerage accounts where sales are made, and there's different things that can create these capital gains. But capital gains rates are either 0, 15, or 20% under current tax law. So with ordinary income, if you're married filing joint, if that's your tax status right now, what would happen if you had a capital gain right now of $100,000, okay, that was the amount of your capital gain, you would not have any taxes owed on $100,000 tax capital gain if, make sure you hear what I'm saying, if all you had was capital gains on your tax return. That pretty much rules out everybody listening to this or watching it if you're listening to or watching our podcast. That's that first bar that you're looking at. That first bar there is 100,000. You are not going to pay any capital gains tax on that. However, as soon as you add ordinary income to that capital gain, which everybody typically has some level of income on that tax return, I'm using in the second bar on this graph, there's a $30,700 amount of ordinary income. That happens to be also the standard deduction. So there's no ordinary income tax paid there. However, that is pushing that $100,000 capital gain. It's pushing it up above the threshold to where now almost $11,000, $10,750 to be exact, is taxable at 15%. And then I have a third bar that has $50,000 of ordinary income. Doesn't matter where it's coming from. It could be wages. It could be a withdrawal from your IRA account, traditional IRA. That is now pushing up the 100,000 capital gain in my example up to over 30,000. So now your tax would be on 30,000 of capital gains at 15%. The point, folks, is this: when you get to retirement, you're not dealing with just ordinary income taxes. You are dealing with different blends of income coming into the tax return. And I'll always stand by this comment. Taxes, when you retire, your life gets simpler because you're not working, right? Hopefully you're enjoying yourself. You're playing pickleball or playing golf. You're traveling. You're doing what you love to do. However, what you are missing is you're missing the opportunity to understand, or someone's not telling you how that tax return works. And I believe it was designed this way to make it more complicated because the IRS knows the biggest buckets of money that most of us carry into retirement is our tax deferred money. And they are coming after it through different means and different channels. They're coming at this money. They can get it through, they don't necessarily, folks, change the brackets. I'm not looking for the brackets to change drastically, the ranges of what we pay taxes on. They do it through the exclusions, the things within the tax return where you got to dig a little bit deeper. And all we end up seeing is, why did I owe this much? And we see people come in our office all the time that go, I still don't understand why I had to pay this much this year. No one's explaining it to them. They're not going back to the accountant. They figure, I'm not going to bother him or her. They're too busy, but they don't understand it. And we can look at that tax return and we could dissect it and then help provide you strategies that you can implement within your portfolio structure with how you harvest money out of that portfolio. Folks, I know this seems like rocket science probably to a lot of you with what I'm saying, but again, when you do it for 3 decades and you're working with people, we're around this stuff every day. We don't expect you to understand this, but we can explain it to you in simple ways that light bulbs go on and people go, why didn't somebody tell me that? Okay. We can't answer that question, but we can put you on the right path and we can guide you to what that looks like. So, that's about, I think, the time we're going to have to really stay on this. And if I teased some of you today, I'm not trying to do that, but I do want to encourage you, if you want to learn more about taxes in retirement, it's been our overwhelmingly biggest response this year to all the live shows that we've done. People are hungry because they're learning, and I think people are just waking up, Mitchell. I think you would agree with that. People are waking up to the fact that this government can't continue to operate like it's operating, over 30 trillion in debt. The interest on the debt alone that we're carrying is over $1 trillion a year. So it's staggering what we keep adding to the debt. But just more than that, people are onto the fact that there's taxes that are coming, and people have worked too hard to just give that money away. So don't focus on just what you're invested in, folks. Get with a fiduciary. We'd be honored if you'd give us a shot to look at your portfolio. Do reach out to us, 910-235-0812. But we're glad that you're tuning in, and we look forward to continuing to bring you information that's going to help you win with your retirement assets, with your tax planning, with your insurance, and everything that we discuss on this show about your money.